What is P2P lending? How does it work? And how can it help you get money to grow your business? That's exactly what we're going to talk about today during our training. You're going to leave this training by knowing exactly what one of the easiest ways to get money is with P2P lending, how it works, and how you can tap into this to actually be able to get the money you need to start and or grow your business. Look, P2P lending is one of the easiest ways to get money. It's easier than dealing with lenders. It's easier dealing with SBA. It's easier than working with alternative lenders, online fintech lenders as well. And that's why you need to know about P2P lending. Even if you don't have revenue, we're going to talk about ways today to use P2P lending to get money to grow your business. And if you do have revenue, well, then that expands the ability for P2P lending to actually help you get the money that you need to grow. So how do you get money from P2P lending? Well, let's dive in a little bit deeper and talk about what P2P lending is and how it works. So when we think about normal financing, then it usually comes from a number of different sources. Typically financing is coming from either lenders, right? Conventional banks, big banks, money that's backed by SBA, or ultimately it could be coming from alternative lenders. And these are now known as fintech lenders. And we've seen a swap there. It used to be that 90% of money came from banks backed by SBA. Now 90% of financing comes from these alternative lenders. But there's an even more alternative way to get money, and that is through what is called P2P lending or peer-to-peer lending. And it's way easier to get than any other kind of financing out there. So how does P2P lending work? Well, ultimately what we're doing with P2P lending is really reshaping the way that borrowers invest. So with P2P lending, we're not dealing with any lender. There is no lender in place. The lender is you and me and normal, everyday, average people. You see, back in 2000 and earlier, let's say when Dodd-Frank came out, I'm not even sure when this actually was, but in the early 2000s. Okay, Dodd-Frank was a law that came out to deal with everything that happened with the mortgage crisis. And one of the things that happened with this was called the Jobs Act. And the Jobs Act actually allowed non-accredited investors to invest in privately owned companies. Now, you might not know what this did, but it caused an explosion of capital that became available for us. You see, historically, if somebody ever wanted to lend money to us, privately owned companies, then they had to have like $1 million in net worth, or they had to have like $250,000 in income. They had to be an accredited investor. But when this happened, when this Jobs Act came, what happened was it opened the door for people like us, average, everyday people, to invest money into privately owned companies. Then what happened was this explosion in crowdfunding. And that's basically what we're talking about. This P2P lending is a version of crowdfunding. No. It's not Kickstarter like you're thinking about. It has nothing to do with that. This is a whole different and new way to be able to fund businesses, fund real estate, fund venture capital endeavors. I mean, it became so many avenues to get money in our hands as private investors. And here's how it works. Basically, a P2P lending platform is in between you, the borrower, and the actual backer, the people that are investing money. And by the way, if you're just coming in, give me a shout out here on the stream, because I'll give you a shout out and I'll give you your company name right here. And I'll let thousands of people see this. It's like free promotion. So type in your company name in the chat and I'll give you a shout out on the stream. So what happens with P2P lending is we're basically dealing with a platform, and the platform sits in between you as the borrower and the backer. The platform is the technology. And what this technology allows us to do is everyday, average day people can invest money, and sometimes starting as little as $25 or $50. So I can go to a P2P platform, I can invest my money. I can invest $50 if I want, or $50,000 if I want. Then what they do is they pool together all the money from these people that are investing into the platform, and then they basically allot the money out in the equivalent of loans. So what they're basically doing is now, instead of getting $50,000 from one source, which is normally how banking works, now we're getting $50,000 from 500 sources. And we're combining all their little contributions together, and that is how that $50,000 gets divvied out. Now, why is this so powerful and effective? Because I have said again and again, and will continue to say, that when you try to get the money you want from one source, the more money you want, the harder it is to go through that underwriting process. The reality is, banks do not want to actually come in. Banks do not want to lend money to one source, a lot of money, because that's a lot of risk. They'd rather take $500,000 and give it to 10 businesses than give $500,000 to one business, because what happens is it basically, like, waters down is the wrong word, but the word cannot pop into my head right now. It waters down the risk, right? They have less risk lending to 10 borrowers than they do lending to one borrower. So this is why getting money from lending institutions is so difficult. Because we want 25, 50, 500K, the more money we want, the harder it is for that lender to let it go to one source. P2P lending is brilliant because it solves this problem. It's taking $25, $50, $100, $500 from all these individuals, then it pulls it together and lends it to one person. So now, as a result of that, then all of a sudden you don't have one lender that's all scared and conservative with their risk. And these P2P lenders are basically using algorithms that make it way easier to get approved than what you ever normally would with a lender. Look, if you're lending somebody $50,000, then you're going to do a lot more scrutiny than if you're lending somebody $5, right? And that's basically what P2P lending is doing, is they're using their own algorithm to assign risk, and that risk is way more lenient than what you're going to find at an alternative lender or a major bank. So what does all this mean? It means easy money for us. It means that we get money way faster and way simpler than we ever have before. As a matter of fact, a lot of P2P lenders, you can get an instant approval. You enter your information, they go in and their algorithm will instantly approve you for however much you're going to get approved for. And typically in as little as 24 to 72 hours, the money is actually deposited directly in your bank account. GDTV is in the house. Thanks for coming in and saying hello. And by the way, if you're just coming in, give me a shout out. I want to give you a shout out on the actual live stream. So that is how peer-to-peer lending works. Now, let's talk through the steps. Step one is you have to find the right P2P lender. So who are the P2P lenders? Well, this is the nice thing about peer-to-peer lending, is that there's two types of financing you can look at. We can look at financing based on revenue. We can look at financing based on personal income. So that means even if we're just starting a business, P2P lending is one of the easiest ways to get the money that we actually want, because we're able to use personal income to be able to get the deal approved instead of revenue, right? And this is what I think is interesting. So many people become affixed on personal loans versus business loans. But if you really separate these two and look at it, a business loan uses business credit, business assets, business revenue for approval. But if you don't have business credit, business assets, and business revenue, well, then you might be striking out trying to get a business loan. But on this other side, if you look at what are called personal loans or personal finances, the only difference is it's based on personal assets, personal income, right? And it's based on personal credit. So that's the only difference between these two worlds. So if you have revenue and you have collateral and you have business credit, well, then business financing works well for you. But if you don't have that stuff yet, well, then you probably want to go to a lender that looks at your personal income versus the revenue because you don't have revenue yet. What's nice about P2P lenders is they look at either or, sometimes both. So they'll actually look at your business revenue or they'll look at your personal income and they'll make the approval decision on one or the other. So even if you're just launching the business, you can get approved. And if you have a well-established business, well, guess what? You can get approved there as well. So who are some of the most popular peer-to-peer lenders? Well, one of them is Funding Circle. Funding Circle is notorious for being really a business-only P2P lending platform. So they basically are lending to a business that has good financials, like good revenue. And they'll loan from $25,000 up the wall, all the way up to $500,000. Okay. And their rates start like as low as like 7.5% or 8%. And then their terms are like 6 months to 7 years. So they have short term and they have longer term as well. Now they're going to want you to be in business for 2 years, and you're going to need to have average or better credit to get approved. But if you have average or better credit and you've got business revenue, well, then Funding Circle could be one of the best options for you, one of the best business to business or one of the best business peer-to-peer lenders that's out there. Now, another one that's not as much, this is a very small lender with very small loan amounts, is called Kiva. Now, I like Kiva and talk about Kiva all the time, Kiva, because what's nice about Kiva is that Kiva actually works really, really, really good for startups. Now, what they're basically doing is lending you up to $15K and you pay 0% interest and they'll give you a term up to 3 years. Now, here's the catch. The catch is that Kiva wants you to get some money contributed from your peers. So Kiva basically says, hey, look, if people around you know, like, and trust you enough to give you some money, we'll give you money too at 0%. And that's what's nice about Kiva. So if you're launching a business, if you want a micro loan, if you want a startup loan, this is where Kiva could actually fit the bill. Not as much a real peer-to-peer lender, but I wanted to throw them in because they could be seen as a peer-to-peer lender because you're getting contribution from your peers. So I wanted to throw them in there. Now, one of the most well-known peer-to-peer lenders and the biggest overall is called Prosper. And Prosper lends you as little as $2K, as much as $50K. They give you rates of about 7 to 36%, and they'll give you 3 years, even 5-year terms, okay? And again, they only need average credit to qualify. 640 type FICO score, you're able to get approved for that kind of financing through Prosper. Now, Lending Club is also one of the biggest. If you look at Prosper and Lending Club, those two account for like 75% of peer-to-peer lending that takes place. Now, Lending Club goes $5,000 up to $500,000, so very, very high loan amounts. They'll go as low as 7% or higher on interest and 1 to 5-year terms, okay? And they want you to be in business for about 12 months, but if you don't be in business for 12 months, then they'll look at your personal income instead. So we get this flexibility of using personal income versus business revenue to qualify. Now, yet another one is called Street Shares. Now, with Street Shares, you can get $5,000 to $250,000. You can get rates of 7% or higher, 3 months to 36 months, so all the way up to 3 years. And again, they're going to want you to be in business for about 1 year. So if you don't have that 1 year in business, then we want to look at Prosper. We want to look at Lending Club because those will look at our personal income versus our business revenue. Upstart, one of the best ways to get money for a business. I'm loving Upstart. Upstart, basically, you're able to get money based on average personal credit history, 7% or higher rates, 3 to 5-year terms, and you can get $100,000 or you can get all the way up to $50,000 through Upstart. So Upstart's another really good one to look at as well. Now, there's some other ones like Peerform and Funding Societies is called, but those aren't as good. Those aren't as popular. I'm not going to walk through every single P2P platform. We'd be here for a long time. I just want you to give you the ones that you're really probably going to use. So let's kind of recap that really quick. Funding Circle, great because they only lend to businesses. Prosper is the biggest in the space. They'll go off personal income or business revenue. Lending Club will go off personal income or business revenue. Street Shares, which used to be notorious for helping veterans, they're kind of still good in the business space as well. And then we also look at Upstart. So some of the best platforms to actually look at. So how does this work? Well, first, we go to the actual platform. Now, they'll typically do a soft credit poll. So it doesn't affect our personal credit whatsoever. They ask maybe 5 questions, very simple, and then they'll give us a pre-approval. So first, we go to their platform, and they have something right on their home screen, and we actually apply for the loan. They ask us 3, 4, 5 questions, like how much money do we want? And then they'll typically pre-approve us right then and there. Now, the next thing from that point is they'll typically ask us for some kind of revenue or income verification. It's very simple. We provide whatever they're asking for, bank statements or pay stubs, tax returns, whatever it is they're asking us for. We supply that to them. Okay, and then we will get a pre-approval without supplying income docs. The income docs are just there to make sure we're not lying. Once we have the income docs and we submit the income docs to them, then they will come back and they'll actually say, okay, here's your formal approval. And then it's pretty much done at that point. At that point, they go get the funding from the investors. They go get the funding from all the investors that are investing, and then they basically distribute the funds to you. Okay, that's how the process works. I mean, the whole thing takes less than 72 hours to actually complete the process. You get pre-approved instantly within minutes, typically. Your income docs, usually those are approved within a day once you supply those. And then you're literally getting your funding in your bank account in about 72 hours or less, which is super cool. By the way, Jimmy Martinez is in the house from YouTube. Thanks for coming in, Jimmy, and saying hello. So a lot of benefits. What are the benefits for you? Well, first of all, let's look at 2 sides of this. Let's talk about borrowing and let's talk about investing because you might want to do both. Borrowing, it's just easier money to get. It's super simple capital to get. Of all the kind of money that's available today, and by the way, I've been doing this for decades, right? I mean, I've got thousands and thousands and thousands of YouTube videos and TikToks and everything. I've been doing this for a long time. And I can tell you of everything I've ever seen, this is the easiest type of financing I've ever seen to get. I mean, it says a lot. Like it's the easiest way to get money. So that's a huge benefit. It's super easy to be able to get approved. And it's super quick to get approved and super quick to be able to get funding as well. So those are probably some of the best benefits. Now, the risks, well, you're going to pay a little bit of a higher interest rate than you may pay with some conventional bank loans. You're probably going to pay less interest here than you would with alternative fintech lenders. But you will pay more than you'd pay from an SBA loan. But you know what I'm saying? Like there's no comparison between the ease of getting a P2P lender loan in 3 days and getting an SBA loan over 3 months. Like that's a whole, not even a comparison. But it is something to consider, right? Your rates aren't going to be what SBA would be, but they're better than most other fintech type lenders out there. And you know, you got to keep in mind that if you're not paying the bills, well, that's obviously going to damage your personal credit, right? Now, what about the benefits of investors? Really high returns. You get higher returns if you were to loan money on P2P platforms than most other kind of investments that you may have. And because they're distributing the money to multiple different loans, then it kind of is a way to mitigate your risk as well. You're not trying to be an angel investor and loan $50K to one person. If you put $50K in, they may loan that to 100 companies, right? 150 companies. So even if a percentage of those decline or default, I mean, you're still going to make your money. So as an investor, P2P lending makes a lot of sense because with P2P lending, like you can invest money and it's distributed to a lot of different kind of clients. And then as a result of that, you kind of negate your risk, right? It doesn't go away, but since you're investing to multiple different companies to one platform, then it mitigates your risk, and then you have the ability to probably get better return. Now, you can also lose your money. These are not FDIC loans, right? There's no FDIC protection. So if you're putting your money in, you have a greater chance of losing it than if you're investing some other things that are FDIC backed. But so some things to keep in mind there as well. But overwhelmingly, the benefits of P2P lending, either investing or borrowing, are through the roof because, again, this is some of the easiest, fastest money you get. Now, think about this. This doesn't just stop at these platforms. There's actually other kind of basically peer-to-peer lending, or now what is really versions of crowdfunding. And this could be from venture capital or angel investors. So crowdfunder, for example, pulls together money from private investors instead of you getting money or get from actual accredited investors instead of just private investors. So this crowdfunding actually gives us a new way to be able to attract venture capital and angel investor money. If you're in the real estate game, well, there's a lot of different P2P platforms or crowdfunding platforms just for real estate as well. So you're able to come in with real estate and you're able to get the money you need to invest in real estate, especially commercial real estate, through these kind of crowdfunding P2P platforms as well. And there's a lot deeper than that, but those are the few areas you really need to know about. P2P lending can be used in the way that I've described it here for you to get easy, fast money. It could also be used for you if you're a real estate investor. You want to look into that. There's a lot of great options for you there. And it also could really be good for you if you're trying to raise private money through venture capital or angel investors. Okay, one of my friends I was with at Top Golf Friday, and he has 13 million followers, or 13 million people that follow his company, and a lot of them have invested in his company. And we were talking about investing, and he was talking about how he's now going and using places like Crowdfunder to raise money. Instead of raising it from individuals, which is what he's done before, now he's going in and using platforms like Crowdfunder to be able to get that money from investors. So again, P2P lending, a lot of different uses. We can get fast, easy money. We can now get angel investing, venture capital from it. We can also get money to be able to invest in real estate as well. So some really cool options. So to kind of recap here, P2P lending, fast, easy money. We're getting money from private investors instead of us getting money from accredited investors. We're getting money from private investors. We can usually get pre-approved or kind of semi-approved within minutes. And we can actually get funded within 72 hours or less. The best sources that we want to look at are Funding Circle. We want to look at Prosper. We want to look at Lending Club. We want to look at Street Shares. We want to look at Upstart. These are the best platforms for us to look at. So hopefully you got value from this training. Make sure you look at a P2P lending. It's one of the easiest, fastest ways to get money to grow your business. If you got value from this training, smash the like button and make sure you subscribe and keep your eye out for our next training. We're talking about more cool ways to get the money you need to start and grow